Welcome to the deep dive. Okay, let's unpack this Medplus Health Services Ltd's Q1 FY26 results. We're working from their latest investor presentation and the outcome of their board meeting, both dated August 2nd, 2025. So really fresh information. Our mission, as always, is to cut through the numbers, the jargon, and really give you the key takeaways, a shortcut to understanding what's happening with Medplus.
Right. And what's fascinating here is just remembering the context. Medplus is a major player. They're the second largest pharmacy retailer in India. So this isn't just about crunching numbers. It's about understanding the strategy, the operations behind a very significant company in the healthcare space.
Absolutely. So let's start where everyone usually does the top-line revenue. For Q1 FY26, they reported $15,426 million.
15,426 million.
And that represents growth, 3.6% increase compared to this time last year, Q1 FY25, and also a 2.2% bump up from the previous quarter, Q4 FY25.
So steady growth, yeah. Not explosive, but consistent upward movement.
Exactly. But what about profitability? How's that looking?
Okay, this is where it gets quite interesting. Their gross margin landed at $4,029 million. That translates to a 26.1% gross margin percentage.
26.1%. How does that compare?
Well, here's the key bit for you. That's a 400 basis point increase year over year. So a full 4 percentage points better margin than Q1 last year. That's substantial.
Wow.
Although it did dip slightly, 40 basis points compared to the last quarter. But the yearly jump is significant. And then there's operating EBITDA. They reported $728 million.
$728 million, okay.
Which, for a retailer expanding like they are, shows decent core operational profitability.
And the bottom line, the net profit after tax, that number really jumped out at me.
Yeah, the PAT, $423.4 million.
$23.4 million. Now, it was down about 17.5% from Q4.
Right.
But the year-over-year growth, I mean, this feels like the aha moment. It's up 195.2%.
Exactly. Almost triple the profit from the same quarter last year. It's a remarkable increase.
What do you think is driving that kind of leverage? Is it just scale kicking in?
I think it's definitely partly scale, yeah. It suggests that their operational efficiencies are really starting to bear fruit on the bottom line as the network matures. They're likely past a certain inflection point. And their basic earnings per share, the EPS, came in at 3.54 for the quarter.
Okay.
So these core numbers, they give you a pretty clear snapshot, right? Strong underlying health, good trajectory, despite some, quarter-to-quarter noise.
Right. So impressive numbers, but how are they actually doing it on the ground? Here's where it gets really interesting, I think. Their store network. We're talking 4,813 operational stores as of the end of June 2025.
4,800, that's huge.
Spread across 13 states, one union territory, something like 730 cities. And they talk about this cluster-based expansion strategy, focusing on, deeper penetration versus wider reach.
Exactly. It's not just about planting flags everywhere. It's about building density, making clusters work efficiently.
So how did that play out this quarter? Any new store additions?
Yep. They added 101 net new stores in Q1. That's 124 opened, minus 23 closures.
Okay, 101 net.
And interestingly, 53 of those net additions, so more than half were beyond Tier 1 cities.
So they're really pushing into Tier 2 and maybe even smaller markets.
Seems like a very deliberate strategy. And if you look at the age of their stores, about 21% of their pharmacies are less than 2 years old.
Wow, 1/5, they're pretty new.
Yeah, 12% opened in the last year, 9% the year before that. So significant recent investment, still ongoing.
Okay, lots of new stores coming online. But what's the story with the established ones, the older stores? Are they still, pulling their weight financially?
That's a really crucial question, and the answer is yes, very much so. The store's open for more than 12 months. Okay, the revenue was basically flat year over year, a tiny 0.2% dip. Negligible, really.
Okay, flat revenue, but profits.
That's where it's strong. They maintained a healthy 10.9% store-level EBITDA margin.
10.9%, pretty good.
But here's the kicker, a 59.8% store-level operating return on capital employed, ROCE.
Almost 60% ROCE at the store level.
Exactly. Think about that. For every rupee of capital tied up in those mature stores, they're generating nearly 60 pays in operating profit annually.
That's incredibly efficient. Way above typical retail benchmarks, isn't it?
Absolutely. It shows that their established network is highly productive, generating cash to fund that new store growth we just talked about. It's not just growth for growth's sake.
Right. It's profitable, sustainable growth.
Well,
Okay, so strong physical network, efficient operations. But they're not just bricks and mortar, are they? They talk a lot about their omni-channel approach.
Yes, they were quite early with that in India, integrating the online and offline.
And the memorable detail for me is always the 2-hour delivery promise, which, as you said, pure online players find really hard to match because they don't have that hyperlocal store base.
Precisely. That physical network becomes a huge advantage for online fulfillment. And it helps in other ways too, right? Lower customer acquisition costs.
Oh, so.
Well, the stores themselves act as billboards, as local touch points. People already know the brand.
Ah, right. So less spending needed on online ads, maybe.
Potentially, yes. And lower delivery costs too, because they're dispatching from nearby stores, not huge distant warehouses. It's a smart integrated model.
Makes sense. It really turns the physical stores into an asset for the digital age.
Sure.
Okay, let's break down the performance by segment a bit.
Sure. So the core pharmacy retail segment, obviously the giant share, brought in $15,106.4 million in Q1.
6 million. Got it.
But the diagnostic services segment is worth watching. It added $302.9 million in revenue.
Okay, smaller but growing.
Growing, and look at its margin, a 13.6% operating EBITDA margin.
13.6. That's much higher than the pharmacy segment's margin, isn't it? Wasn't it around 4.6% overall?
The overall operating EBITDA margin was around 4.7%, but the pharmacy segment itself was 4.6%, yeah. So diagnostics is significantly more profitable on an operating basis, diversification paying off there.
Interesting. And what about their own products? The private label strategy?
Yes, that's another key pillar. They have a huge range, over 1,350 SKUs now. That breaks down into about 820 plus pharma products and 540 plus non-pharma items. Think FMCG, cosmetics, packaged foods.
1,350 SKUs. That's a lot of own brand stuff.
It is. And the crucial part is that this private label basket generally offers much higher margins than selling third-party brands.
Right. So growing that share directly boosts overall profitability.
Exactly. And for you, the listener, this means more choice, potentially better value on some everyday items, and it signals Medplus is thinking bigger than just being a pharmacy, more like a broader health and wellness retailer.
Okay, so putting it all together. What does this mean for their financial strength and where they're headed? So what does this all mean? You mentioned a strong cash position earlier.
Yeah, very strong. They ended the quarter with $5,549.3 million in cash and bank balances.
Over 5.5 billion rupees. That's a solid buffer.
Absolutely. And their working capital cycle looks well managed too, around 59 days for net working capital.
Okay, and cash generation, are they burning cash to grow or?
Yeah. No, they're generating it. Strong operating cash flow of $1,872 million in the quarter. And after accounting for capital expenditure, they still had free cash flow of $1,072 million.
Over 1 billion rupees in free cash flow in just one quarter. That's healthy.
Very healthy. It shows the underlying business is throwing off cash.
And what about those IPO funds they raised?
Yeah.
How are they being used?
Good question. The presentation updates this. They've invested the bulk, about $4,671 million, into their main operating subsidiary, Optimal Health, mostly for working capital. Another $448 million or so went towards general corporate purposes.
Good.
And there's still around $669 million unutilized, which they've safely parked in fixed deposits for now.
So financially sound, generating cash, well-funded. What are they saying are the key priorities looking ahead?
They've laid out 3 main pillars for future growth. First, keep growing within existing clusters and developing new ones across metros, Tier 1, Tier 2, and even beyond. That deeper penetration strategy continues.
Right. More stores, wider reach within those clusters.
Second, really leverage that omnichannel offering. Expand the market, keep customers loyal, and specifically extend that sub-2-hour delivery to more places.
Makes sense. Convenience is king.
And third, push the private label share higher, both in pharma especially for chronic and subchronic conditions where repeat purchases happen, and in FMCG. Because, again, higher margins.
Growth, omni-channel, private label. Seems like a clear plan. Any other housekeeping from the board meeting?
Just the usual stuff, really. Formal approval of these results, appointing new cost and secretarial auditors. They also allotted about 79,000 equity shares under their employee stock option plan, the ESOP.
Okay.
And they've set the date for their 19th annual general meeting. The AGM is scheduled for September 15th, 2025.
Good to know. So overall, it sounds like a company with a solid financial base and a pretty clear roadmap for expansion and improving service. Good news for customers, potentially.
I'd say so. The financial stability and this clear strategy suggest they're well positioned to keep growing and refining what they offer you.
Great. Well, that brings us to the end of this deep dive into MedPlus's Q1 FY26 results. We've tried to give you that comprehensive but hopefully concise overview, pulling out the key nuggets from their investor presentation and board meeting update, a shortcut to getting informed.
And digging into this raises an important question, I think, for you to ponder. Given MedPlus's strategy, this relentless cluster-based expansion, especially the push into Tier 2 and beyond cities, how might that deepening penetration really change the game for local healthcare access and competition across India in the next few years, particularly when you factor in their omnichannel strength and that growing private label range? What could this actually mean for consumers like you, not just in the big metros, but right across the country? Something to think about.